Alrighty, let's go ahead and get started. Welcome everyone to the HUBB Live Trading Room. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like. That's the main point to take away. We have the news of housing numbers pointing to an unusually strong buyer's market, which I find very interesting, with mortgage rates hitting a record high, at least in this month. And yeah, just interested to get into that discussion with Rob, among many others. And of course, very excited to interact with you all. So let's go ahead and kick off. Rob, how you doing?
Good, Zach. How are you? Welcome, everybody, to the HUBB Live Trading Room. Happy Wednesday afternoon to everyone. Yeah, it's interesting what you mentioned, Zach, and I think what may be going on there in the housing market is, I've been complaining about how rates have been going up, but it's been across the spectrum, across the yield curve. But now we have a little bit of a tick up on the longer end, which overall is a positive as far as potential economic signs. But I think what it may have done is get people off the fence that have been trying to decide, do we want to buy now or wait, et cetera. And that has likely created that interest that you mentioned, and we'll have to see, is it a lasting thing or is it a short-term thing? I think that's where the question's going to come in, and it'll be interesting to see from that point in time. But let's get into this. As I promised, I was going to do a brief market update, and then we would go to the AI signals and spend the majority of the time there. Uh, Lots of signals, lots of things to talk about as far as where the signals may be of interest. If we take a look at the S&P, we are trying hard to hold 660, and you can see on the high of the day, we're off the high of the day at the moment, trying to climb back up off a little bit of a dip, but there's the 50-day moving average. So even though we had a little bit of a move higher, until we break above that 50-day moving average, it's all kind of meaningless. And a break back above the 50-day moving average puts us right back to the 10-day moving average and that resistance level at 675. If we break that, then we may have something going here. Notice of interest here is that the algorithm has not turned this three purple yet, meaning that this could still just be a corrective phase within a longer term zigzag pattern, long wave three to the upside, and maybe we stay in the wave three for a while. That would be of real interest considering how long we've already been in the wave three, but you go by what the charts tell us. One last thing I wanted to point out here, and then we'll move off the S&P, is you can see really just barely getting this negative 1030 cross. And could that be just a bit of a flip-flop back and forth, whipsaw they call it, where maybe it turns right back up around? We would need that market bar to get back above the 50-day moving average, whether it's today or tomorrow. We'll talk more about this in tomorrow night's insiders meeting. We'll have a little bit more information on where we close today and where we close tomorrow. So we'll have two closing days of data to look at during insiders tomorrow night. So let's just jump quickly to the bond market, and you can see that still just kind of meandering, waiting for direction. We're nearing the end of November. We have the Thanksgiving holiday coming up. The Federal Reserve had said they would stop their shrinking of the balance sheet around December 1st. So maybe a little bit more of this sideways chop. And then could we get a bid back in the markets in December? I believe so, if the Fed starts injecting liquidity again, as they have said they were going to. What they say and what they do are oftentimes two different things, as you know. So it depends on whether or not they come through with that. I think that's more important on whether or not they do the December rate cut or not. And I believe you mentioned this last week, Zach. They did come out and officially say there's not going to be a full-on October jobs report. They're going to release the September one, but not a full-on. It's going to be an estimate or some sort of a scaled down version of the jobs report for October, and then they're going to start bringing up the numbers again in November. I find that kind of interesting. You have to wonder, do they just not have enough time? Is there some politics being played here? That's, conspiracy theory comes out in you when you hear stuff like that. We know the jobs market's not good. We did get a number across the pond that showed that their inflation rate has ticked down a bit. Boy, if we could see that here, then we may be full bore with the Fed injecting liquidity and cutting rates. That would most certainly put another bid back into the market. So not a whole lot to talk about as far as the bond market now, just kind of playing status quo, other than a little bit of a dip down in price, and there's that tick up in yields. Inching towards the longer end of the curve. And that's what you want for a healthy economy. Not that we have a healthy economy, but perhaps the market, at least the bond market, is looking ahead to where if these things come to fruition, more liquidity, rate cuts could reignite the economy. And maybe that's what's being looked at moving forward. I had mentioned, was it yesterday or Monday? Zach, it might have been Monday. The days all run together with all these live shows that we do on some of the things that we're moving seem to show interest on the liquidity side. And perhaps maybe the Fed is starting to really slow down on the reduction as we move to the end of the month. Maybe they've started injecting, maybe not. Maybe it's just the shrinking of the balance sheet and the withdrawal liquidity has slowed down. And that would be helpful as well. We did have news. I'll just show you this on Google. Zach talked about, was it yesterday, Zach? I think you said the release of the new Gemini version. Obviously, very well received news with the big move on Google to the upside here. I wish there was a more definitive pattern on Google, because I would love to do something with Google. Although it's my favorite stock in my entire history of trading Elliott Wave. More trades on Google, more successful trades on Google than any other stock, and it's really not even close. But this isn't really any sort of a significant pattern. What we do have is a little bit of an expanding triangle here, but clearly we can't do a strangle on Google. It's just too expensive. But we are at the upper end of it, and if we could break above that and take off, we could be moving significantly higher on Google. So something to watch there, especially if we move into an environment of more liquidity. All right, so with that, not really much else to say. I will show the VIX real quick, and then we'll move into looking at the AI signals and what may be on the horizon. There's one, a bullish one, believe it or not, that is interesting to me today. But looking at this VIX move to the upside that occurred yesterday, we're at 23 and 0.6 right now, so a little bit lower than this at the current moment. So this is following pretty well the weekly trend line. Remember that upper line there is the weekly trend line of the VIX. All right, so taking a look at the AI searches, there is one today, and yeah, I did cheat. Normally I don't look at them beforehand, but I wanted to spend as much time as we could looking at signals, so I did kind of already look at the list today, which I don't normally do before we do this show. And I wanted to talk about the setup here on TK Tankers. Kind of gets you away from just talking about other aspects of the tanking industry and just focus on the numbers there. I messed that up, so we're going to take this off and start this zigzag over again. I want to hit it just right. So just as a quick reminder, a lot of times people say, and I'm doing this even though it's the AI show, um, because trading zigzags within the wave three is one of the main things that I look for within these AI signals. So I want to get this zigzag right. And people are always asking, where do you start the zigzag? How do you know where to start the zigzag? Well, the A wave is the initial impulse wave. So you look to what is clearly the start of the impulsive move in the wave A, and that's clearly this bar right here from back in August. So you click there at the bottom, then you come up. That's obviously where the A wave ended. And then you bring it down. Remember, you have to click in this green box. And you can see that we got close to the 78.6% fib level. We didn't get there. But the first level, so this is still a qualified zigzag, now confirmed, is that 100% extension. And we got there, we traded there for over a week, and we've continued to move higher. And look at the ascent angle. How many times have you heard me talk about how I much prefer a 45-degree angle because you have less volatility in the corrective moves? We're always going to get impulsive and corrective moves in stocks, and that's why LA Wave works so well. But when you have a 45-degree angle, it means that the corrective moves are normally less volatile, less severe. They still occur, just not as bad as when you get the vertical stuff. So what happened here was a bit opposite of what usually happens. Normally you get the 45-degree angle, then the FOMO kicks in and it goes vertical, and then you know that, at least for the short term, that move is probably over. Here we had a bit of a vertical move off the B wave correction, and now we've moved to 45 degrees after passing the 100% extension. Pretty interesting and unusual stuff there. Now, the 161.8% extension would be if we get the extended C wave. And you know that occurs oftentimes within a wave three, far more often in a wave three than a wave five. It can still happen in a wave five, but far more often in the wave three. And then the AI target at 77%, pretty high score on the bullish side in this choppy environment that we've had over the last couple of months here. Is just above where the C wave extension is. So even if we only go to the C wave extension, we're still up around 67, which is a ways away from here. And then we have the AI target up at 69. So I really like this one. And you may see some sort of an alert come out on this very soon, possibly today, maybe tomorrow, as we wait just a little bit more into what's going to happen in the last hour of trade today. And then after that, the signals go down to where I wouldn't really be interested on the bullish side. Let's switch over to the bearish side, which is where all the action has been. And you can see all of these bearish signals that exist on the list here. A long list. And obviously with the choppiness in the market, you can imagine that there would be a lot of signals. But look, the top signal here is only a score of 65, and that's on GPN, Global Payments. Now, there was some information on the financial networks today that perhaps there are some positive signs in early retail buying for the holiday season. I've been mentioning that there's concern about this year's retail season with the fact that the middle to lower income part of the economy is struggling a bit more. And there was concern about how strong the retail season would be. And I've mentioned that you never want to count out the U.S. consumer. No matter what's going on, we find a way to spend. There's been concerns about elevated auto loan defaults, credit card late payments, etc. All those things are showing the strain on the U.S. consumer, but somehow we find a way to spend during the holiday season. Coming down here, we are a little below the 10-day moving average on this. It does seem pretty much destined to hit that target. And remember, the zigzag stuff works on the downward moves just as much. So you come here, you can see this bar started the big downward move, and then we see the corrective bounce up here, and we went to 45, almost 46, almost to a 50% extension. And then look where the 100% extension is, down here, right around where the AI signal is. So that's pretty enticing, if we weren't already a little bit oversold here. And then you look, well, is it even worth it? Because we're at 71 and a half, going down towards 69, a $2 move and a $70 price stock. Is that enough to even make it worth putting on a bearish trade? Probably not. By the time you pay whatever, a small slippage getting in and out, I don't know what the options look like here. Let's take a quick look and see. And yeah, it's pretty wide. So even on the short-term options, look at all this open interest. And isn't it frustrating to see that amount of open interest and this wide of spreads? That's been one of the more frustrating things for me personally over the past month or so, is the market makers are getting away with creating these wide spreads. And there's very little that we can do about that. There's rules in place that market makers can widen spreads when they feel like they're taking on extra risk. If the volatility is elevated, well, the volatility is elevated. And so it gives them kind of that, it's almost like a loophole in the securities rules, and they can do this. And we see it often with low open interest. And so, we're used to that. But when you see that, and there's tons of open interest, thousands of contracts here, that's where it just gets irritating. And there's not much we can do about it. We can't complain to anybody. We can't say this isn't right. Get the securities people to look at it. It's never, no one's ever won that battle. They've always been able to come out, they being the market makers, on top. If we go out a little bit to January, which should be when you have that kind of open interest in November, you should have some good open interest on a January contract, because those are leaps or were leaps at one time. And you can see the spreads are tighter here. So from that vein, it's a good thing, because we want to go a little bit further out. We wouldn't want to buy November puts anyway. We wouldn't want to go out to January. So then you're like, all right, they're really attacking. And I think what this means is it shows how many retail traders are out there looking for short-term stuff. And the market makers are taking advantage of those. We are in, no doubt about it. I'm getting older by the day, and the younger generations have an attention span of a flea. It's with all the social media stuff and everything, and they're very impatient, and they like to do things on a short-term basis. And so I believe market makers are preying on that by these wider spreads. They're taking advantage of it for all those people that want the instant gratification of being right immediately. And I think that's pretty clear by the width of the spreads on November options and then going out to January. So this looks a little better. Slippage isn't so bad here. It's just, again, it's a short window here of the movement, and I just don't think it's worth it in this vein. Going to the wave 5 bullish sign, you can see there's no symbols on today's report, but I think that's going to explode with potentials once we finish this little bit of a corrective phase. And again, maybe we have another week or two of this choppiness. I'm just going to jump back to the S&P real quick. If we can hold here, even if it goes down to 650, that's a pretty good level. Look, that goes back to an AI signal on the upside back in July. So if we can hold somewhere in this corridor between 650 and 660, which I think is likely, and get to the end of November and get to what at least the Fed has told us is going to be a time of liquidity coming back, maybe another rate cut. If it's not in December, probably going to be in January. If we can get a lower print on inflation and the jobs market continues to be suspect, that's the double whammy. That's the double mandate, that the dual mandate that the Fed always talks about. So I think we're nearing an area here where we could see some bounces, and a lot of stocks have been hurt in this move. You've seen them, I'm sure. And so a lot of those downward moves are going to be set up for wave 5 buys. And I think that's going to be the place to be. We've been waiting on this. We said when it was released and we weren't getting signals, just wait, its time will come. That may be coming here pretty soon in the next week or two. And that would be quite interesting. Then we go to the sideways search, sideways with a drop. Some of these have been, we've got a couple of them, but some of them been a little bit frustrating where we've had nice drops, but not as high as scores as we would have liked to have seen. And then we see this double AI score here, which I think is quite interesting, where we had the drop score was only 52%, and then we have an AI wave 3 down score that's 28%. So both of these two AI signals are telling us we don't really think this is going to stay in this range. There's likely going to be a move one way or the other with a low score on the wave 3 down. Not quite enough for a fade trade, but getting in that area that perhaps we find some support here and get a little bit of a bounce back, but nothing to do with that right now. And so let's go back in the calendar a little bit. That's one of the things that I said I would do, is we'll look at some of the dates going back, because there's a couple that are interesting there as well. You can see here nothing on the sideways stuff other than maybe this Canadian solar here on the sideways, very low score in red. The boundaries are likely not to hold. That's what it tells you when you have a low score there, and it could be a directional move. The way to fade that is a strangle, and the fact that we had such a vertical move up and we've come back down, it does put you in an area where you would consider, okay, what happens from here? And when we stop here, do we continue lower and retrace the entire vertical part of this move? What goes vertically up oftentimes comes vertically back down, but doesn't always cover the entire move. Sometimes it does, sometimes it doesn't. And then the other side of the coin is that enough of a corrective move from the vertical nature of this? We find ourselves and turn and move back up. Now, this is Canadian solar. You know, the U.S. administration is kind of a little bit negative on solar and wind energy right now, preferring other avenues. And but this is different, and so this could be a potential strangle. We want to see how much of the move could we get, and it's not as easy to figure out how far the move is going to be on a fade trade as it is on a regular triangle formation, whether it be ascending, symmetrical, or descending. But I do note the size of the boundary here, and that's pretty good, a pretty good range there for a stock that's trading at $25. So we don't need much of a move on a strangle for this to work. You look for a 10% move from the stock price to generate a strangle that can potentially make money if it moves, and if it moves in a reasonable amount of time. Those are the two things that has to happen for a strangle to work. Stock has to move, and it has to move in a reasonable amount of time. So the AI tells us it should move within 21 to 24 days. That's the time frame that it's looking for on the move. So that's what AI says about strangles. So the whole setup here looks pretty interesting to me. So then what's the next step? We go look at the options again and see where are the options on this. Open interest is sporadic here, wider on some. We wouldn't do November anyway. Notice there are weekly options on Canadian solar. So that all usually tells you that, hey, there's probably some pretty good liquidity somewhere if they're going to create weekly options. First thing we'd probably look at is the January monthly. Notice that after that, we skip down to April, and that's getting a little too far. That kind of negates the delta gamma relationship that we talk about all the time, because the gamma goes too far down and you don't get the delta gamma relationship on the acceleration. With 58 days, that makes it, at 45 days, we start to get time decay. And then time decay really occurs at 30 days. But you can withstand that 30 to 45 day window if you've got a good setup. But at once there's 30 days left, you're really fighting time decay pretty hard, especially on the option on the other side of where the stock is moving, if it indeed moves. But the spread here is kind of wide. We look at the delta. I need to bring in more symbols. So I'll go up here to where it says strikes. Let's go to 12 strikes instead of just 6, and then see what it looks like when we get down to a delta that we'd be really interested in. And so somewhere maybe because it's a lower dollar stock, we can sneak a little higher on the delta, but it's still 50 cents wide on a 75 cent to $1.25 bid-ask spread. That's too wide. Then we come over on the call side, and even with the January options, if we try to coincide that delta at somewhere in the 40 range, we could look at this strike here on the 28. It's 70 cents by 95. A little better on the spread there. 25 cents is still a little too wide, but at least it's better than where we are over here on the 26 strike, that corresponding delta on the put side. 50 cents is a bit wide. So what you could do is just put the mid price in, see if you get filled. You may not. But then remember that once we're in, they're more apt to let you in on splitting the spread than exiting on splitting the spread. So that's something to keep in mind. How much profit can we make? And normally you would probably say probably not enough of a move to recover the spread and generate a decent enough gain to make it worth putting on a position. And that minimum that we like to look for in a strangle is 30%. Can we make a 30% gain? Well, on this one, I think maybe we can because of how wide the boundaries are. So that, just in general terms, you look at stock trading at 25 in general terms, one standard deviation would normally be $2.5 to $3 move. But because these bars were so big here before the drop, it allowed the boundaries to expand, and even a one standard deviation move, because these bars had so much intraday volatility, is a bit wider. A lot of compelling things there for a potential strangle. So we'll look at that one pretty hard. Let's get back into the directional stuff here and see what we can find on the bullish side. Oh, we got to go back to the next calendar day again. Nothing really. 51's too low. Don't really want to look at anything there. Let's go to that list on the bearish side. Once again, a much longer list. And you see Visa up here. You look at that and it goes against what was just said today as far as there's early signs that the consumer is spending. Well, okay, the AI was already right. We already came down and hit the target. Look at that. Yesterday, we hit the target. Wouldn't have put this one on. You can see that. And this is, we know that this is where the dichotomy comes in with the AI signals, that when the AI identifies it, it's obviously going to be in a momentum run. And sometimes that momentum continues. And then other times we go through some backing and filling and corrections before we finally take off. And if you've watched these, even on some of the ones that we've run out of time, eventually these AI signals end up becoming right. So, it's the whole timing thing has changed a little bit of the way I like to trade, because I do like to get the highest delta gamma relationship that we can get on those out of the money options. And the further out in time you go, as I've mentioned, gamma goes down. Gamma is always higher in the front month option, and then it goes down as we move forward in time. So when you have a setup like this, and you've already had a big part of the momentum run, uh, it makes it challenging to go further out in time when the continuation is the next day. So that makes it hard. But you see, there was an opportunity on this signal. It's only a 63 score, but clearly there was a big breakdown on Visa, and there's other things to look at. It's okay, it's not a 70 plus score, but that was massive support right there on Visa at 335, and it broke below it. That has to be considered too. We love the AI as an additional and a comfort building, confidence building indicator, but we still look at regular technical analysis rules in addition to that. But for me, the fact that we were down here too far from that 10-day moving average already, then we opened yesterday right here, or excuse me, Tuesday. Yeah, yes, still yesterday. I thought I said Monday before. I might have, but yesterday it opens up here, and you're thinking, okay, well, that could have given you about $6 of movement to the downside, but the separation from the 10-day moving average creates pause. Are we going to bounce first? Might have got a little greedy. We broke a major support level. We went straight down. We're separated from the 10-day moving average. Oftentimes, we're going to get a bit of a bounce back first and then move back down towards the target. But as you know, other times with these AI momentum signals, it continues a little bit further away from the 10-day moving average, and the target gets hit before that reflex bounce happens. I do think this one's going to get a reflex bounce on Visa, and it could be a good 1 or 2 day trade moving forward from here as we're still down here towards the lower end. And just as a further rule that you have to keep in mind, that 10 period moving average rule that I talk about all the time, no security in any time frame gets too far from the 10 period moving average, at least not for long. But on a downward move, it can be a little more extended away from the 10-day or 10 period moving average than on an upward move. So when you're overextended on the upward side, I'm even more hesitant. But on this one, may have missed this, trying to be a little too picky here with where we opened, getting the bounce up, and then entering for the downside move. It didn't do that. It opened, traded down, hit the target, and then closed off of it. So this one could actually turn out to be one of those oversold fade trades if the market can give us any sort of a bullish impetus on this next week or two. But this is just that 1 to 3 day trade. So there was lots to talk about on Visa, even though it was a lower score. So I wanted to go through that. And then notice the lowest score in the entire bearish list is not even low enough to do a fade on. It's 36 on Capital One. So another big financial, seeing two different stocks when there's probably more in the list. Haven't gone through them all, but there's probably more. So you're seeing two major players with Visa and Capital One that are both showing these moves down. And that was based on the concern of consumer spending and the release on those concerns over auto loan payments and credit card payments, et cetera. And then we've hit this 200-day moving average right here. I don't often put that on there, but I thought for today it makes sense, especially when you're looking at something like Capital One sitting right at the 200-day moving average, sitting right on that wave 3. The AI says we could come down here, but there's very little not very little, not enough confidence for us at 36%. So just like I mentioned, Visa could bounce off its target that got hit. Could Capital One follow suit? You would think the two of them would move in tangent because they're in the exact same sector and industry. Maybe we get a hold here at 200, adding the round number into play, and we could get that reflex bounce here also. And I'm not saying that, we're going to be off and running, we're going to get great retail numbers. What was looked at very bleakly has a ray of hope based on what was said this morning. But again, these are just the short 1 to 3 day trades that you can do in these AI signals. And I hope everyone is looking at the amount of possibilities that are created in these AI signals. There's so much more to it, and that's what I'm trying to highlight each and every week here, than just looking at the top scores on the bullish or bearish side. Is it 70, 75 or above? 75 is the gold standard. I've done 70. Haven't noticed a huge difference between the results on a 70 score versus 75. But there's so many other things that you can look at on all of these searches, other possibilities. There's tons of trading opportunities with these AI signals. And if you're not taking advantage of it, that's why I'm here each and every week to try to help you understand, wow, there's way more trades I could be putting on than what I may be actually doing or utilizing. So pretty interesting stuff there, I think, with all of these searches. And then making sure we're staying on the day before on the wave 5, there was one STZ. And like I said, I think this is going to be king. The wave 5 search, maybe it's another week or two away, but around the beginning of December, I know I repeat myself a lot. I do it for two reasons. One, to emphasize a point, and other times to make sure that people that are newer, that may not be as up to date on the vernacular, etc. We're adding new people every day, are aware of the rules that I'm talking about. But Constellation Brands, alcohol, tobacco, gambling. So we're in the area of the sin stocks, the stocks that do well, even when the market's not doing well. And we hit the 38.2% spot on the wave 5 to the downside, which would entail, if that wave 5 is indeed over, a move back up towards the previous 4, which would exceed the AI target at 77%. This one, I think, should be quite interesting as far as where we are. You don't have to believe that we're going to get a big market rally. It may be just a move in the right direction from liquidity, etc. But some choppiness could propel this one up towards that target. So I think this one is really interesting. And so next step, obviously, we look at the technicals and we want to go see what's the options. I've had hit or miss on the options regarding Constellation Brands in the past. We wouldn't do anything in November. We do have weekly options, so that's helpful. And notice that there's even weekly options in January. Make sure you click on the monthly one. We don't want to fool with that extra time decay in the January weekly options. If you're going out to January, use the monthly. If you're putting on a credit spread, then you do the exact opposite. Then you'd want to do the January weeklies. I hope that makes sense. If you're on the debit side, you would want to do the monthlies. If you're on the credit side, then that extra juice that's in the weekly premiums, the extra time decay on a credit spread or something along those lines, that would be interesting. We haven't talked a whole lot about credit spreads. It confuses the heck out of people that are to the world of options, but it's a great strategy, especially in an environment right now. So if we have an area, and I'll talk more about this in the insiders meeting tomorrow night. Um, it's just going to be myself. Jeff is out of town, so I will be along with Zack hosting the insiders meeting tomorrow night. So we'll have a little extra time to talk about things. And so what I want to do is bring in the concept of a credit spread because the VIX is elevated, volatilities are elevated, and so when volatility is low, you want to stick to the debit side. There's not enough credits to make it worth it. But on the periods of time where volatility is a little higher, that's when you want to look at the credit spread side of things. And so creating a put credit spread, which is a bullish credit spread, you can go out of the money, you can go in the money, but then you're negating what we're trying to do is take advantage of higher volatility. So that doesn't really make any sense. You want out of the money put credit spread so we place it just underneath support is, and even if it doesn't go higher, even if the stock doesn't bounce up, as long as it stays above support, the credit spread's going to gain value for you. Volatility will come out, time decay will come out, and a January credit spread makes a lot of sense. And then when we come down and look at the width of the spreads, maybe a touch wider than we'd like, but within the 10% range. So very doable and pretty good open interest. I think this makes a lot of sense to put on a put credit spread, just out of the money here. We want to go through and do a little more analysis and make sure that we could go. Maybe we have to start at 130. We did a 130. Now remember, they're going to charge you margin on a credit spread, which is super aggravating. Another battle that I fought for years until I just gave up because you're not going to win. It's a credit spread. It's still fixed risk. I don't understand why there are margin requirements in any fixed risk trade. If you're selling naked options, yes, there should be margin because it's risky. You shouldn't be doing it in the first place. But if you are, then I get why the broker wants to protect themselves. If you're taking substantial risk on selling a put or unlimited risk on selling a call, either one of those naked, I get it. But anytime there's a fixed risk trade, why is there margin? It makes no sense. Argued, and the expression, my mom used to say this till I was blue in the face. I don't really know what that means because when you get angry, you turn red. So I don't know where that expression came from, but just gave up. So when you look at this on a 10-point spread, you could bring in a credit, in the area of a few dollars, but the remainder is going to be a margin requirement. So you might have to put up $7 to make $3. And, a lot of people shy away from that. A lot of people don't understand credit spreads anyway, but they kind of shy away from that because I don't want to do anything. That doesn't make any sense to me. Why would I risk more than I can make? It's all risk reward because you have a higher chance of keeping that $3. You've got a higher chance of keeping that $3, making that $3 on an out of the money credit spread than you do on making $3 being right on a directional trade, on a debit trade. That's why it makes sense, even though at first blush it doesn't. So anyway, we'll expand more on that tomorrow night. So with that, I'll open it up, Zach, to some questions, but hopefully everybody will be with us Thursday night when I'm going to take a few of these concepts, specifically the credit spread one, a little deeper.
Yeah, absolutely. Looking forward to that session with you. We'll start out with a question here from Maria. I was assigned on FI, thoughts on just holding and green wave 3 downside, and then a follow-up question.
Okay. Yeah, Maria, I was wondering, I hadn't seen any assignments yet. We haven't been assigned. I haven't been assigned, but I thought, because it has that big thing, you're in the money, that there could be a signal there. I think this might be one, oftentimes if you have an account, I know a lot of our subscribers love it when they get assigned and they hold the shares with the long put, and they've created a protective put one step away from a collar strategy, because we know on these signals that eventually they're likely to bounce, especially after these huge moves to the downside. Just a reminder to everyone, if you're going to look for options on FI, you're not going to find them. The new symbol is FISV. Still says FI on the website, but the symbol changed. So it's FISV is the actual symbol. But on this one, Maria, the way it sets up and the target's down here, this might be one that take assignment of the shares, sell the shares, and hold the long put. I think makes a little more sense on this one. Um, the one fly in the ointment here is that the drop score was 69, so right at 70%. So there was a pretty good likelihood that we would hold this, but we haven't so far. And then we add in a new signal here to the downside, a little more than toss of a coin. So it depends. If you have the account size to hold the shares and keep the put, that would be the safer play. If you don't have the account size to do that and you're looking for the adjustment, I think I would sell the shares and hold the long put and see if we don't tick down a little bit more, and then we could make a nice gain that way along those lines. Maria, while you're watching, I just wanted to let you know, because you had asked the question on Crocs. I might have gotten a little greedy on this one. I was wanting it to break below this level here because there's nothing until 50. That would have been we could have said it, Zach. That would have been a Katie bar the door. It's trying really hard to hold this support level. So what we're going to do here is we're going to add a call and turn this into a strangle. So just wanted to expand on that, Maria, because you had specifically asked the question, I believe. I think I'm right on that. There is a pretty good size move getting ready to happen on Crocs. If it holds the support and bounces up, it's going to run to 90 before it runs into any resistance. And if it does break below this 75 level, it could go as low as 50. The AI has it down here around 66. Look like maybe we were about to do that. And then we get a little bit of buying that came in and supported it. It's not huge volume, so it could still go either way. This could be a little bit of a bounce, and then we head back down. But I know you had asked the question, when are we going to close this out, when we had the big downward move. And so I just wanted to eat a little crow here and say I might have got a little greedy, thinking that, wow, we could really have a grand slam trade here if it falls apart. It didn't. It bounced back up. So the prudent thing to do now is to play both sides. So we're going to add a call to this and create a strangle out of it. I don't know if you're still in it, Maria, but if you were, then I just wanted to share that with you. So, okay, next, there was two parts, you said, Zach?
Yeah, next one for you is also STNE. The AI has failed. Should we get out? Looks like it has broken support. Thanks.
It has. And this is where the area of the signs of liquidity were coming in. It's hit the fail zone. We're below the 10-day moving average. We're at the last bastion of where it could hold, right through here. And so I just wanted to give it a little bit more time to see if we bounce here, a la what happened with Crocs. If not, Maria, then you can see the next target's down here at 12.5. And so rather than just getting out, we're going to give this today's close and maybe tomorrow. There's still a little support at 15. So there's a corridor right here where it could bounce. But if it doesn't, and we're a little bit early on any sort of a reflex bounce, then we'll probably just turn this into a put and capture that move down here to, it's more like around, it is 12.5 is where we would go. So that's the plan there, Maria. Remember, it's an 80% score, and we've seen this before where it takes a while. But those targets with the high scores usually end up being right in the long term. Oftentimes, it frustrates us with the amount of time it takes to get there, but they usually end up being right. So we'll give this one just a little bit more leeway with the idea that if any sort of a bounce doesn't materialize, you can see this is almost exactly where Crocs was when you ask when are we going to get out of that, and it did bounce. So let's see if this one follows suit. If not, then we will look to move to the downside there. Might not be a bad idea to do the same thing with Crocs, is turn this into a strangle, because there's some room to the upside here too. It's a low dollar stock, and a move down to 12.5 would be profitable in a strangle. A move back up to 18 would be profitable. So some things to consider there, and that's why patience, understanding the adjustment process. We've turned some pretty good losers into small losers or winners with the adjustment process. And sometimes it's frustrating to see the account in red for a while, or the trade in red for a while. But if in the end, we recover the loss or make a gain, it's certainly worth it. So anyway, that's the plan there. Sorry, I spent a lot of time on a couple things there, Zach. Let's keep going.
No, all valuable insight. Question from Lana on the 20th of October. Wave 5 bullish had 5 AIs above 75. A month later, most have failed. What else should we be looking at, or should I be looking at?
I think the key here, and the reason you didn't see more of those signals come out, is the whole liquidity thing. If you watch the U.S. market update, I know you guys as subscribers have the advantage of these live shows that others don't, but I do try to put a lot of information into those U.S. market updates on the weekend as well, and show that liquidity chart. And even though we had some scores on the wave 5 buys, which I do think will all work in the end, I just felt like it's maybe a little bit early, because of the fact that that's where it's more than just a cookie cutter look at the score and follow suit with that. There's other things to learn, and so doing my best to continue to educate and creep in other rules, so that you can be a well-rounded trader. That's the whole idea in the end. So that's why you didn't see more alerts come out on that, because I did see those higher scores, but difficult for stocks to bounce too much. I have made the comments, I think, quite a bit, that it is going to be hard for the market to move higher, at least significantly so, when the Fed has announced, and clearly we have the data from the data scientists at HUBB. They're the ones that create those liquidity and macro charts that I show on the weekend update. So I guess what I'm trying to say is, even though you get the advantage of all these live shows and the ability to ask questions, they don't get any of that in the U.S. market updates. But I do try to put some good information in those. And one of the things that I try to do is periodically show those macro charts. So don't give up on those. If you got into some of them and you're like, none of them are working, we're nearing the end of this. If, and I got to keep highlighting the word if, the Fed is going to do what they told us they're going to do. If they follow through, then you're going to see all of those rebound, and wave 5 buys can rebound back to that 4 rather quickly. So we just get into a slightly better liquidity environment. We already know we're looking towards rate cuts. We just don't know if it starts in December next year. A little more patience there, I think, will be rewarded in the end. So keep those higher wave 5 bullish scores in mind. Notice, I think this furthers what I've just been opining on here, with the fact that when we go back to last night's, there aren't any, right? So we went from some that had high scores to not any. And we have the INVH with that tick up in the long end of the rates. The news that you said hurt this, Zach, as far as building homes, because remember, this is apartments, so it hurt that a little bit. So we might just have to be a little more patient on this, but I think this one comes back too. after this initial rush of people are, oh shoot, rates are ticking up. If we're going to buy a house, we got to do it right now, even though prices are elevated. I think a lot of people were waiting. All right, rates are still okay, a little higher than they were, but we're not going to see 3% rates ever again. And we're going to wait. And we were getting a little bit of a bid under INVH. Then that news comes out, and it was a short-term negative. But I think this is a winner over the long term. We're just going to have to be a little more patient. And I think that's the same with the other signals you were talking about as well.
Thanks, Rob. That was a super insightful session and wraps up all the questions for today's webinar. So back over to you.
Great. Sounds good. Well, I'm glad we still got the questions in, even though I rambled on, but I promised that we would spend a little more time on the actual AI one. So hopefully that was a worthwhile session for you, spending an hour of your trading day with us. And again, I hope everybody will join us on the Insiders meeting Thursday night, where I'll take a couple of these concepts and be able to spend a little more time on them once again there. So have a great rest of your trading day. Look forward to talking to you tomorrow night. Take care, everybody.